Welcome to Bay Mountain Capital's latest video blog. We appreciate you taking the time to sit with us, and today we are going to discuss this wacky world we're currently living in, including the COVID-19 pandemic and what we're seeing from the industry from a hard money lender's perspective. I'm Will Dyer. I am a principal and a chief investment officer for Bay Mountain Capital, and I'm here today with my colleague, Wayne. Wayne, please introduce yourself.
I'm Wayne Corley. I'm one of the principals at Bay Mountain Capital, and I'm in charge of single-family originations.
So today we're going to basically talk to you what we've seen in the industry. You know, how have we reacted from a lender's perspective, and what we're doing, what our business is like currently, and what we're seeing. And so Wayne and I are just going to have a casual conversation. Hope you enjoy it, and we'll go from there. So, start us off. Wayne, can you give us some ideas on, kind of your perspective on moving into the COVID-19 and the quarantine and all the fun stuff we've been seeing?
Well, mainly I've been noticing there's uncertainty right now. So ARVs aren't necessarily certain, and just the market in general is uncertain. So I think it's good for experienced investors who have previous knowledge and know what they're looking at and have the ability to get across unexpected hurdles. It might be a little tougher for beginners just because you don't know what you don't know, and in an environment like this, that can be tough.
Yeah, that's actually very true. One of the things that we did early on when we saw this coming was to kind of tighten our lending parameters. Before the whole COVID-19 epidemic hit, we would lend to new flippers. You didn't have to have experience. The only thing we really looked at was your credit score, and depending upon your credit score, depending on the terms that we'd offer you. Now we completely changed it, and we are requiring experience, at least one flip in the last 3 years, to know that you have some idea of what you're doing. Because as Wayne mentioned, it's what you don't know that hurts you being a newbie in this business. And we even give better terms for people who have even more experience. Now, if you have 3 or more flips underneath your belt, you're going to get some pretty good terms from us, because we're still seeing applications come in. We're still seeing people who are out there trying to find deals. One of the other things that we did do as well was, beforehand, we would lend a lesser of 100%, up to 100% of total cost, purchase and rehab, or 70% of the ARV, whichever one is less. Now, because of the uncertainty, we want a little bit more skin in the game. So we had backed it down to 90% instead of going all the way up to 100% of total cost. Wayne, why don't you speak a little bit about how we've been able to maneuver and even purchase loans, because some of our competition is looking for liquidity.
Yeah, because we've been around for a while, and we have been through ups and downs before. We are positioned now to some of the other smaller lenders who might have overextended themselves. We're buying some of their loans when they need to get some liquidity. And a lot of the reasons we're doing what we do with the borrowers is really to protect the borrowers themselves. I mean, we really consider ourselves partners with borrowers, and beginning borrowers might not understand what they're getting into. So that's the reason why we require experience. And experienced borrowers, we're requiring them to have a little bit more skin in the game, just so they, understand, hey, I need to have maybe a little more liquid funds than I did before, just because, again, of the uncertainty.
Yeah, that's true. And, it's interesting right now. We actually are seeing somewhat of a hot market still. And I think it's a combination, especially in the last couple of months, that there was some pent-up demand, I feel like, when everyone all of a sudden went straight into quarantine and weren't allowed to, really get out there and, look for deals. And now you're seeing people getting out there looking for deals, a little pent-up demand, as well as you're seeing a lot of people buying houses, people that might have been quarantine in an apartment, in a 2-bedroom apartment, and decide, it'd be nice to have a backyard if we have to do this again.
So the great interest rates right now. So
absolutely,
the market is hot.
That's one thing that the government is doing great for industry is by having historically low interest rates. I think I heard today that they're predicting the 30-year fix is going to drop below 3%. It's never been below 3%, at least in modern history. So it's a great time to get out there and buy. Now, what we are seeing is it's getting a little bit slower, in my opinion, just the process, because people are trying to be aware of the surroundings, social distance, things like that. Our appraisers are trying to take a little bit more time. They don't want people in the house when they go through an appraising and things of that nature, but they are getting out there and they are doing it. And we are seeing a lot of good deals start to come back in.
All of that activity, though, has affected the timeline on some of our deals, just because appraisers in general are just super busy right now, either with refis or with retail buys because of the low interest rate. So sometimes where we were able to get appraisals in a matter of days, maybe it's taking a few more days. And that's just a byproduct of all the busyness that's in the market right now for those appraisers. So that's something that we do ask our borrowers to be a little cognizant of, is because of that third party time frame that we don't control, they might want to have a little more time on their contracts.
Yeah. And the other thing that people are all continuously asking me is, if we truly are heading into a recession due to closing down the economy, what's it going to happen to what's it going to cause to the industry? And it's our thought process, at least my thought process, is that people are still going to be out there buying homes, and people are still going to be out there wanting to flip. Wayne, why don't you speak a little bit about the last recession we went to, and how Bay Mountain Capital fared through it?
And that's actually when we started, right in 2008. And we started by being, I think, really kind of partners with our borrowers and helping them kind of understand some of the pitfalls and understanding that, there's a lot of deals out there right now, but you need to do your own due diligence. You need to understand how values are being determined, and understand how rehab budgets are being formed, so that they can make, a good decision, because there's going to be a bunch of deals coming, but unless you know how to analyze them yourself, or come with a hard money lender like us who is going to help you analyze them correctly, there's still a lot of pitfalls out there.
I agree. And an interesting fact, I'll tell you, especially for our industry, in the 2009, 2008 Great Recession, the average age of a flip was 6 months. So people were speculating strictly on appreciation, and it had nothing to do with adding value. In 2018, 19, we got back to the same volume that we were seeing in 2006 in the flipping industry, but the biggest difference is that the flips on average were 40 years old. So what this is telling me is that the industry, the flippers out there were doing good. They were coming in, taking product that was more or less taken out of the market just because it had been abandoned or needed to be revived, and they're putting those houses back into the economy, which is great for the first-time home buyer, which is actually doing a lot of good for especially some of the middle and lower income neighborhoods in major cities like Dallas and Atlanta, and you're seeing those neighborhoods actually rejuvenate and come back to life. It's all due to these flippers out there looking to the next neighborhood to get more good deals. So, any words of wisdom as we conclude, Wayne, to our borrowers and our flippers in the industry?
Just be careful still. I still think that there could be some things in the economy that might happen this fall that could affect ARVs. There's still some good deals out there, but just be real careful in your underwriting. Make sure you understand how the values are being formed, the ARVs. You're not taking somebody else's word for it. Be careful, sift through the deals, and I think everyone will be okay.
No, I agree. I think right now you just got to make sure you have all your senses on, and make sure you're looking for the good deals and not trying to overstretch. But we appreciate everyone taking time to spend with us today. I hope that we gave you some sort of intel into how we're seeing things from a hard money lender's perspective. If you want to check us out, we'd love to hear from you. Go to our website, which is www.baymountaincapital.com. We've got some great other blogs to help some of the people that are more on the new side of this business. And if you want to reach out to us, we'd love to answer any questions you might have.
Thanks, Will.
See you later, Wayne.